Welcome to this explainer. Today, we're putting G3 Apparel Group right under the microscope. We're going to analyze their strategic crossroads using the legendary valuation frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham. If you've been watching the retail space at all lately, you know that this is a company standing squarely in the middle of a massive transition. So we're going to dissect the data and the recent earnings reports to discover exactly what's driving the wild volatility in their stock, and we'll evaluate their aggressive pivots, just like an expert investment analyst would. So here's the million-dollar question we need to answer today. Is G3 a classic value trap, or are we looking at the ultimate turnaround play? You know, the legendary Peter Lynch loved categorizing companies, and right now the market is completely split on exactly where G3 falls. Are you buying a company whose best days are stuck in the rearview mirror, or are you getting in on the ground floor of a lean, highly profitable turnaround? Here is our roadmap for today. We'll hit the G3 Apparel crossroads, the PVH revenue vacuum, their pivot to owned brands, that massive Marc Jacobs acquisition, unpack some pretty mixed financials, and finally, weigh the bull versus bear case. All right, let's jump right into part one, the G3 Apparel crossroads. 0.63s, that's GI's current price-to-book ratio. Now, in the financial world, a multiple this low, it practically screams Benjamin Graham. I mean, if we run this through Graham's defensive investor checklist, trading this far below book value offers the exact margin of safety he always demanded. And when you look at it alongside a price-to-sales ratio of just 0.38, the intrinsic value formula strongly suggests the market is pricing in a worst-case scenario. But to really understand why the market is applying such a steep discount, we have to look at the primary catalyst for this downturn. Which brings us to part two, the PVH revenue vacuum. We're talking about a $470 million hole in lost sales. Yeah, you heard that right. For years, G3 was riding high, benefiting heavily from licensing Calvin Klein and Tommy Hilfiger, but PVH made the strategic decision to pull those incredibly lucrative brands back in-house. When we apply a discounted cash flow or DCF framework here, suddenly losing $470 million in top-line sales dramatically alters the company's projected free cash flows. This right here is exactly why the valuation models have punished the stock so severely. To put that in perspective, fiscal 2026 revenue sat at $2.96 billion. But looking ahead to their fiscal 2027 guidance, management is projecting net sales to drop to around $2.71 billion. That is an expected 8% year-over-year revenue contraction. And let's be honest, in a stock market completely obsessed with endless growth, an 8% revenue drop goes over about as well as a lead balloon. But the story definitely doesn't end with lost revenue. So, what's the game plan? Let's look at part three, pivoting to owned brands. G3's proprietary labels, think DKNY, Karl Lagerfeld, Donna Karan, and Villa Prane, they actually already accounted for nearly 60% of their net sales in fiscal 2026. Looking through the Warren Buffett lens, this is a super fascinating shift. By actually owning the brands instead of just renting them, G3 is trying to dig a wide economic moat. Controlling the supply chain, the design, and the distribution gives them real pricing power, a higher return on equity, and ultimately far better owner earnings. And the proof is kind of in the pudding here. These owned brands demonstrated double-digit growth in the very first quarter of fiscal 2027. And leadership is completely all in. CEO Morris Goldfarb stated that this go-forward portfolio is expected to deliver high single-digit growth. This ties perfectly back to Peter Lynch, who absolutely loved companies with clear, understandable consumer products that are out there aggressively capturing market share. And they're backing up that confidence with serious investment, launching huge marketing campaigns like bringing Hailey Bieber back as the global face of DKNY, and pushing Donna Karan's reemergence with top-tier supermodels. But they aren't just relying on marketing. Alongside the brand shift, G3I is trimming the fat. They're implementing a comprehensive cost-saving program designed to realize $25 million in run rate savings by fiscal 2028. If we frame this in terms of a DCF model, operational efficiency directly boosts that terminal value in a discounted cash flow analysis. It basically proves that top-line revenue isn't the only way to build intrinsic value. Expanding their profit margins through cost cuts protects their bottom line, even as their overall sales transition. Okay, moving on to part four, and this is the big one, the Marc Jacobs acquisition. G3 announced they're participating in a massive $850 million deal to snag the iconic Marc Jacobs brand from LVMH. It's a bit of a complex structure, so let's break down how this deal works. Step 1. G3 is forming a 50-50 joint venture with WHP Global to own the Marc Jacobs intellectual property. Step 2, G3 is funding approximately $500 million, using cash on hand and their credit facility to completely acquire and manage the operating business. And finally, Step 3, G3 enters into a long-term licensing agreement with that new joint venture. As CEO Morris Goldfarb noted, Marc Jacobs is one of the most influential names in fashion. If we look at this from a Buffett perspective, Marc Jacobs is a brand with a deep, entrenched moat that generates massive, consistent consumer loyalty. Adding this prestige label checks a major box on his investment checklist and perfectly accelerates G3's shift toward premium, high-margin apparel. Now let's get into the numbers in Part 5, unpacking the mixed financials. Look, Q4 of fiscal 2026 was, well, essentially a disaster. They reported a net loss of 76 cents per share, which was driven heavily by a super painful $17.5 million bad debt hit from the bankruptcy of Saks Global, alongside some unmitigated tariff impacts. But fast forward just one quarter to Q1 of fiscal 2027, and boom, they unexpectedly beat estimates with an adjusted EPS of 19 cents. Most importantly, though, their gross margins expanded by 350 basis points year over year. Applying the Peter Lynch lens regarding turnaround stocks, this sudden margin expansion is exactly the kind of early indicator he looks for when a business is successfully transforming. And here is the absolute wild card. G3 boasts a debt-to-equity ratio of just 0.01. They've reduced their total debt by an incredible 96% and are literally sitting in a net cash position right now. This is the exact slide where Buffett, Lynch, and Graham would all be nodding in total agreement. Having near zero debt while trying to navigate a massive $470 million revenue transition provides the ultimate margin of safety. It meets the absolute most rigorous boxes for financial health, giving management the financial runway they need to make bold acquisitions like Marc Jacobs without betting the entire farm. So, bringing it all together, Part 6, the bull versus bear case. Let's synthesize these valuation models, right? The bulls are looking at a lean, high-margin powerhouse trading at a massive discount, armed with a totally bulletproof balance sheet. If you run a base case DCF, factoring in that 8% revenue drop, but modeling in the cost savings and the early margin expansion we just talked about, the fair value per share likely sits way higher than the current price. However, the bears, they are pointing straight at the massive execution risks. Can G3 really integrate Marc Jacobs smoothly while simultaneously filling a $470 million hole? In their DCF models, bears assign a much higher weighted average cost of capital, or WACC, due to these execution and macroeconomic risks, which frankly drags that fair value right back down to earth. Which brings us to the ultimate question we have to ask ourselves. Can G3 successfully stitch this new portfolio together? Will their aggressive pivot to high-margin owned brands and the blockbuster addition of Marc Jacobs really be enough to overcome that massive PVH revenue vacuum? Whether Benjamin Graham's deep value metrics will win out or the bear market's DCF growth fears will be fully realized depends entirely on this execution over the coming quarters. Thank you so much for joining us on this explainer. Keep a very close eye on those margins, and we'll see you next time.